Hi, Fraser Jack here, and thanks for watching this video number 3 in our educational series on income protection insurance. This particular video is going to be about what we call, or what the insurance companies call, a benefit amount, a benefit period, and a waiting period. That's the terminology, and I'll explain to you exactly how that works. A benefit amount is really about the insurance company looking at your asset, which is your income, and saying that they can insure up to 75% generally of that income. So if your income is say $80,000 a year, that is your asset, and the insurance companies will insure up to 75% of that, or $60,000 a year, which equates to about $5,000 a month as a benefit. So the benefit amount, if your income was $80,000 a year, would be around $5,000 per month that you could claim if you were unable to work. The benefit period is the length of time that a claim will continue to pay. Now, there's a lot of different benefit periods. Sometimes a claim will pay for 2 years, sometimes it'll pay for 5 years, or sometimes it can pay all the way out to 65 or even longer with some contracts. So that is, if you can't work again, it's going to look at providing you a monthly income for the rest of your working life. The next thing is a waiting period. Now, a waiting period is the length of time that you need to wait before you can start claiming. So you can select different waiting periods. Of course, you can get a shorter waiting period, but it adds some cost to the premium. You can get a longer waiting period, which will reduce the cost of the premium, but it really does come back to getting some advice around the amount of time that you can wait versus the amount of money you want to pay for the policy. So the way that the waiting period works is if you have an accident or a sickness on this day, and let's just assume the waiting period is 30 days, because that was where we find a lot of industry standards around waiting periods. After 30 days of not being paid, you can start being paid. So if your benefit period is for 5 years, for example, and you're off for 5 years, you can continue to get paid for that 5-year period. If it goes for longer, then you continue to get paid for longer. And of course, the longer you have the benefit period, the higher the premium is going to be. And the shorter the benefit period, the shorter the premium. So there's a lot of variables in there, and it will affect the pricing of the policy. So sit down with your advisor, speak to your advisor about the best waiting period, the best benefit period, and also talk to them about making sure that your benefit amount is as high as you can possibly get it, before the insurance companies cap it at that 75% level. Thanks for watching this video. We hope you got something out of it. Keep watching the rest of the videos. We're going to go pretty in depth into some policy options.